I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone exciting, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward at what might happen in coming weeks, and hopefully lots of great ideas and opportunities for you throughout this show. Well, the stock market churned again this week, as the past 2 weeks have seen the major indexes trading in a narrow sideways range, actually with a very slight upward bias, as we have seen the major indexes move to new highs this week. And this has been during a period in which earnings have seen a high rate of them beating estimates. In fact, it's up around 80%. So it's been a very good earnings period. And it really has to make me wonder if all of these great reports coming in the market is not able to surge to the upside if it's all priced in. And with all of this government stimulus that we have seen that has gone on for, like 13 years, you got to wonder with this action if we're at peak earnings. Well, peak earnings would mean that all of the stimulus has lost its power, and that also could be in line with what is peak economic growth. Remember, Q2 economic growth missed very significantly, and the stock market is now at all-time highs with the potential for that growth waning. Early in the week, we saw the most weakness as there was some tough talk out of China about more regulation for their tax, and oil plunged 4% on Monday as China really is giving us demand concerns as there's a potential for a lot of slowdown there with all of the real regulatory shifts that are going on there. And that did weigh on the energy stocks. Tuesday was a big early upside reversal. The market did look weak, but Apple and the solar stocks surged to the upside, and that day actually had 6 straight positive hours, if you look at that. And the S&P 500 with a solid gain of about 36 points. Wednesday, Citigroup came out and they downgraded the stock market, and they said that is because they expect surging interest rates. And the ADP came out, that's the private sector job creation. It was a big miss. It was very weak. And the fear was that it was foreshadowing potentially that would happen on this Friday, which turned out to be incorrect. What did happen was Fed Clarita came out and said that the Fed may be closer to tightening than suggested at the last meeting. Bonds reversed big to the downside, and the S&P 500 lost Tuesday about 23 points, reversing part of the gain it had on Monday. I'm sorry, that was Wednesday and Tuesday. Thursday, Fed Waller came out and he said accommodative policy may be pulled back sooner than they had discussed. So we have the Fed now starting to come out and leak that kind of rhetoric as they are potentially setting up the markets for a change coming soon. But Goldman Sachs, they came out and they said the S&P 500, their target now for 21 is around 4,700. So they are looking for several hundred more points to the upside for the S&P 500. Earnings on Thursday had some pretty wide ranges. Healthcare stocks got really nailed as Cardinal Healthcare and Citigroup came out with very disappointing earnings, and they fell hard. But there were great earnings out of Copa and Hawaiian. Those are both airline companies. And that led travel and leisure to the upside as the reopening sectors of the market really began to surge. Airline stocks, big gains. Wynn, Resorts, MGM, they had huge gains. And the S&P 500 managed to put on about a 28-point gain, which came really in the last hour of the day. Friday, well, that's right now, as we're doing this at midday, and it's kind of a mixed day. We're seeing the S&P 500 up on the day, and this is after the employment report was fairly strong. And when that news came out, the bond market got nailed. In fact, bonds right now are down about 1 3/4 points on the 30-year, and yields are popping. And as the bonds go down, what happens is that the dollar goes up, and because money is attracted to the U.S. dollar with the higher yields, and then the metals get slammed. And that's what we see going on right now. The job report came out at 943,000 jobs created. There was talk of anywhere between 800,000 and over a million, so it was on the high side. U3, this was the surprise. Unemployment rate, the headline number, 5.4%. So that dropped pretty significantly. Remember, there was a day when 5% was considered full employment. But now that we've spent years of government invasiveness, that pushed that number down to pretty consistently into the mid threes, there's a greater expectation that they can get the employment numbers even lower. There was also big revisions to the previous month's jobs created. So all of that really has the bond market moving to the downside and following some very big declines, with gold down $50 on the day right now. For the stock market, here we are in August. We had expected a correction that would begin sometime late June or early July and last into somewhere around mid-August. But that time frame now is passing. We have, of course, many commentaries on social media and people that write to me that simply say, with the Fed acting as they are right now, with all this stimulus, there's not going to be any corrections, no more. There's no more corrections, and there's no more bear markets, and all of that has been simply erased. Well, that's what they're writing to me. And of course, when you get into that mentality, you know that people are pretty much complacent about any declines coming in the market. And they ask me what could really cause the market to move to the downside. Well, when you do get to times when you have historic extremes, the market is really at a time when there is risk. And the market tends to reverse and go into declining phases or bear markets without really any indication. And all of a sudden, the reason for that makes itself apparent. You don't really know that at the beginning. There is something here that's really interesting that I want you to see, and I think this is important as we switch over and look at one slide over here I'd like to show you, and take a look at this. This is the S&P 500 versus margin debt. I want to thank Lohman Econometrics, which brought this from FINRA, and I think this is important. So what we're looking at here is looking back into the mid-90s. And when margin debt gets to 2 standard deviations, it's a problem. Now, if you look right over here where the peak was in 2000, margin debt got to 2 standard deviations. That meant that there was such an extreme of traders, of investors taking on margin, that once the margin debt started to move down, as you see right over here, it really implodes on itself. It really kind of caves in because selling brings selling, and of course you get the bigger bear markets. Look what happened here in 2007. You could see the same thing. Margin debt got to 2 standard deviations. And then you got into a bear market once the margin debt started to collapse. And again, it's all selling, building on top of selling. And it brings you long declines. Eventually, you get to 2 standard deviations on the downside, as you can see right over here. And then we went into this long period where it kind of hovered around trend, and the market moving up for a long period of time. And so we've had this bull market now since 2009, and is now at over 12 years, 12 and a half years on the upside. And look what's happened. We have now reached 2 standard deviations of margin debt, and it is now turned down. that is a very bad sign for the markets. Historically, when you have these type of things occur, you get really long declines. Now, if you look back into the 20s and 30s, actually, after that Great Depression, the market actually was able to hold up for a pretty long period of time. But the last four events have seen some long periods of markets pulling back. Here we are right now, and you can see there is a huge excess of margin debt. There is a ton of complacency in the marketplace. And once the margin calls really start to happen, you can see what will happen. The market will move down. It will move down sharply, and that will be a big problem for the markets once that begins to unravel. Historically, these reversals, as I said, don't really give you any indication other than they just begin to happen. I've discussed that there's going to be the bull market will end, and there will likely be a decline in the markets into 22 or maybe 23, and I've shown that in my long, bigger picture analysis. And when it starts to unravel, you can see it's bad. Margin debt turning down is a really bad signal, and it's likely just to begin to implode on itself. That is my call, reiterating that I think there's a peak in this bull market in this year. I thought it would be in the second quarter. Now it looks much more, of course, like it's in the second half. But the signposts ahead read steep downslope ahead. And I think that you've got to be extremely cautious when you see this kind of information. For the week, the stock market is, let me just jump back over here. I have a lot to show you. You can see, and eventually I'll get to where I want on these slides. For the week, the stock market major indexes are fractionally higher. The S&P 500, NASDAQ, all of those have made all-time highs this week. The bond market, 30-year, very choppy week for it. It's down about 0.75 of a point for the week right now in the 30-year. And Friday down almost 2 points right now. The 10-year yields, which have also had a volatile week, are now trading up about 6 basis points on the week, coming off from a pretty low number, about 1.12, now at 1.29. And it really looks to us like we've seen the low in yields. And while they might have a little test of those lows sometime out here, I think that the lowest points or yields are in, and there's going to be a time out there where we're going to see yields spiking to highs above the highs that we have seen so far this year. The precious metals market does not like it when interest rates go up and the dollar follows, also going to the upside. And the dollar's having a big update today, about 0.6%. So when that happens, gold moves to the downside, silver moves to the downside, and they're really getting nailed today. Gold down about 48 right now. The silver market rebounding from being down over $1. No, let's see, it's now down over $1. So on Friday here, down about $1.25 for the week, and that's all this interest rate move that's really affecting it. We've done an update in there for our level 4 members, so if you're watching this, you can go see what those charts look like, and they're slightly revised from what we brought out on Wednesday. The dollar for the week up about 0.8%, and it still looks to us like it's going higher. We have been projecting to over 94 and potentially over 96 for the dollar in coming months. Oil down about 540 on the week. That is a big hit. It peaked right at the spot that we were looking at, and all momentum now has turned negative on the oil market. Coming up, we're going to look at the world market ETFs on our momentum tracker. This is for longer-term holders, and I think you're going to find that interesting. And then I'm going to bring multiple time frame analysis. We'll look at the stock market, and then I've got some bonus symbols for traders to see that I think you're going to find fascinating, because we're always looking for ways to help our our membership and the people that follow us improve their trading. And this version of multiple time frame analysis, you're really going to see how important it is. When there are certain alignments, the markets move in those directions in a big way. Again, this is that look at margin debt, and you can see 2 standard deviations having turned down and trouble ahead. I want to remind you, go to askSlim.com and you can learn all about our site, and you can join, become a free member, or take advantage of the level 1 special, and I'll tell you about that. If you're watching this on YouTube, please do subscribe to this channel, click the notification bell, and we do many videos each week, and it'll let you know when we put them up. Make sure you give us a thumbs up, like this video, and if you follow us on Twitter, follow us at askSlim. If you do use Twitter. Any questions on our membership or anything else regarding our offerings, write to Matt at askSlim.com. All right, we're going to look at the momentum tracker. I think this is really important for you to see, because we cover so many things for shorter term traders, and I wanted to focus in on how to really get a sense for longer term holdings, looking out several months to a little bit longer. And our momentum tracker is a great app for that. So and it's available to our level 1 members. So I'm going to show you that right now as I put up the momentum tracker. So this is a really great app that we have built. And we'll look at the world markets in here. And this has over 1,000 symbols in it in canned sectors. And it's built for momentum analysis with our proprietary algorithms. So I'm going to move over, and I'm going to select, and you can see the canned groups that are in here. And what I want to look at is the world markets, where are they? Right over there. So U.S. World ETFs. You can see all the canned groups that we have in there for you to look at, but I want to give you a good example of what this is. So I'm going to select this, and you're going to see the world market ETFs come up. So what we're looking at here is the momentum tracker and how it uses our proprietary algorithms to give us specific information. So let's just take a look here. You can see this is the diamonds, which is, of course, the Dow Jones Industrial Average. The directional bias, which is based on our proprietary algorithms, is shown as very bullish. And I'm going to show you how long it's been in this bullish mode. That suggests strong positive conditions, minor declines, and higher prices. And that's been quite good. Our long-term, intermediate, and short-term alignments, you can see, are in green. So it shows you all momentum conditions are in positive conditions. If I look over here at the directional bias ratio in this pie chart, what this is showing you is all of these country ETFs in here that are 54% bullish, there's 38% neutral, and only 8% negative. If I wanted to look at the long-term conditions, you can see in here 92% of all of the world equity ETFs that we follow on here are bullish. If I go to intermediate term, you can see that it starts to come down because things have been changing on the intermediate term. And if I look at the short term right over here, well, you've had some recent improvements. So the shorter term is a little bit better. So overall, as you can see, it gives you the information about each of those time frames. I can scan on directional bias just by clicking on it, and it'll tell me which are the most bullish and which are the most bearish. Let's go back to the diamonds right over here, and I'll just scroll down over here so you can get an idea of these world ETFs that we're looking at and what their conditions are. And let's go back here to the diamonds, and I'm going to click on the chart in here, and we have a longer term chart which gives you our proprietary indicator, and we have built this now on TradingView charts, which is just it's great to see us begin to integrate those. Look at the indicators in here. So what we have are these each of the intensity changes by the quality the intensity of the momentum conditions. And you can see all the way back here, going back now for 9 months is where this is going back. All of this has been in positive mode, and it hasn't changed. The intensity has gone from moderately positive to kind of a middle positive to very positive. Real strong that you see there in the Dow Jones Industrial Average. So that chart has not been lying when you look at that, and the stock market has been quite strong. So let's just look at the ones that are very bullish, and you can see that the diamonds are EWW is the Mexico, and you can see there's your QQQ, very bullish, SPY very bullish. Germany and Europe, FEZ, are slightly bullish, as you can see in there. Russia, RSX, slightly bullish. EWY, now it's starting to lose intensity. So you see this one is slightly bullish. It's got it's kind of neutral in the intermediate term, so you're not really getting a very bullish reading in here. And then EWY, you can see that, well, it's also neutral right over here. So it's neutral to very slightly positive when you look at that. When you look at Brazil, EWZ, it's pretty mixed, but the short term over here is giving you a red, so it's maybe leaning a little bit more towards neutral, as you can see right in there. Now you'll notice the stock market has been, of course, very strong, the Dow very strong, but you look at IWM, you can see in here that it doesn't give the green like you see in the Dow, because it's neutral here in the intermediate and short term. So that is giving you an indication that, as we know, the Russell has been weaker than the other indexes. Let's just go back, look over here at the FXI. I'm actually going to go back to the top and just scroll right over here on directional bias. We'll bring the FXI up, which is China. Let's take a look at that chart and see what it looks like and when it has turned so negative. So I'm going to go to charts right over here. See, the metrics are in there when they change. And here is the chart, and you can see that it was positive back over here, looking back at February, March. All of a sudden, it went really faint positive right over there and started to go neutral, as you can see. And then it started to turn negative, and it turned negative well in advance of getting absolutely slammed here. So that was really, really good information, and it really got you to sidestep where you lost all of the strength at this point right over here, and then began to turn negative, and just turned very negative right before it really started to get hit. So a lot of value when you look at that. So I wanted you to be able to see how you could get some sense around the major country ETFs or some of our other canned groups or sectors that you can look at in there. So there's that list right in there, as you can see. You can also go to single symbol mode right there, and then just type in a symbol. So if I type in Apple, it'll bring Apple up, and you can see Apple is bullish clearly, as you have the long term, intermediate term positive, and the short term is at neutral right now. So that's for this outlook of 3+ months. And gives you a good sense how you can use this. So that is the askSlim Momentum Tracker, and I think a very valuable tool to use. The stock markets around the world mostly in very, very good shape. And I would say that it's really something that if you want to learn more about, you can go to askSlim.com and get that momentum tracker where I looked at the world ETFs in here. So the overall world ETF still quite strong, as we can see. Now, if you want to get that momentum tracker and many of our other things, I'm going to suggest you go to level 1 membership right now. And we have a special on that. So the included in the level 1 membership is that askSlim Momentum Tracker app. You're also going to get our weekly stock index report with lots of great technical tools and charts on there. You're going to get our Spider ETF review. And these are both weekly with technical analysis on the major sectors. You're going to have access to our new trader and investor workbench, where you can we just put in some even improved ways for you to organize and prioritize and save and track all of your own work, your analysis on there. You're going to get the archive to this show where you can go back and review all of our analysis and the style that we have in our analysis, and you'll also get our askSlim live replays, which are about 70 minutes long with a lot of teaching and analysis on there. And we'll even give you some special member videos that we'll put in there. Regularly, that's $19.95 a month, but the special price right now is only $10 a month. If you sign up for first quarter here, $30 for 3 months. That's a 50% discount. Just go to askSlim.com to join. Right at the top of the website, there's a link there, and you'll be able to just click on it and pay $30 for 3 months for this great app and everything else that you see in here. If you have any questions, just write to Matt at askSlim.com. This is the analysis on the S&P 500, and I'm doing this different this week. One of the reasons I'm doing it different is because I brought out analysis in Future Speak on the stock market, which is pretty much still valid right now, and I'll just review that a little bit. And we shared that on YouTube for a very rare special that we put that out there. So that's why I'm going to do something a little bit different right now. I'm going to look at multiple time frame analysis, and I'm going to do a little trader bonus on here, where I'm going to show you multiple time frame analysis that can really put you on the right side of the market, looking at the Dow Jones Transportation Average and the financials and silver. I just kind of wanted to mix it up. So you could get an idea of that. We're going to start out by looking at the stock market and our regular analysis, and then we'll dive into some of the specials that I'm going to show you right in here. So what I want to look at first is the weekly chart that I have been sharing and talking about, this yellow area where we get normally pretty steep corrections. You can see in all of these cycles in here, and I'm just going to look at these last 3 right in there, when you get into these corrective phases where there are 2 cycles coming down, is when you get your biggest declines. And this, during this very bullish time frame after the pandemic crash right over here, declines were very shallow. Momentum conditions kept restoring to the long side and the positive side, and we still have momentum conditions right there. That is our reversal scout, which is our momentum indicator we use on the weekly chart. So this is a very positive time frame where you have long rallies and minor declines, long rallies and minor declines, and then a long rally again. We had projected this period in here, because of this bigger cycle coming down, that it would likely be a steeper correction. We had anticipated that it would move down during this cycle period, a corrective period here, minimum of 11% from the peak. We revised that to 5.3 to 7.7, which bring you down to these 2 support levels right over here. And then because of the action we're seeing in the market right now, there is a potential, and especially for the mega caps, that this might move out by a few weeks right over here. And that's just the market telling us that there is that possibility. So we're looking right now still, even though we've made this all-time high at 44.40, for this to roll over and to go into one of these more mild corrections, much less than we had originally been talking about. That's just the market telling us that that's the likelihood right now. So what I want to look at now is the market in a different way. We're going to switch over to the daily chart first, and then I'm going to show you a 2-hour chart. So this is a slight variation of the daily charts I normally show, and I took out all the yellow bars and all the lines, because I want it to be easy for you to see and easy for you to read. There is a dominant cycle that you can see right in here. So those of you that are new, this is a cycle bracket. This is a drawing tool. This simply is a guide, and you can see how closely it's following the cycle rhythms right now, where you have a long rally and then correct down through the 19th day. These are measured. These are now set at 20-day lengths right in here. It rallied and then moved down through the 21st day. It rallied and then moved down through the 21st day and rallied and moved down through the 19th day. So these are average length at about 20 days, as you can see. There's also a mid-cycle low. And when the market is very strong, you barely get any dip into those mid-cycle low periods, as you can see. And this one, again, was almost invisible, negligible. This is the slim ribbon, and it gives you our momentum indicator, which shows you when they are aligned on the long side. It colors the bars all green, and it tells you that the momentum conditions are positive. That's also reflected on the bottom when the momentum conditions are green. This is the slim ribbon PO. And this is only available to our level 4 members, and this gives you momentum signals, as you can see, which indicate the likelihood that you're going to continue to move on the upside, or you might get neutral. What is really interesting is through this whole period in here, it has never been red. There has not been one moment of negative momentum on this daily chart. And we've said many times, while we're looking for the market to go into a correction, it has not given us, the momentum conditions have been strong the whole time, and without that changing, you're not likely to get a decline. So we see right now that we're rallying through I'm going to tighten this up for you to see right here. We're now rallying through the 14th day, and we're expecting this will decline into 19 to 21, let's say somewhere over here. So it's about a week and a half of likely pullback to what are these support levels right over here. So if that's the case, that doesn't really entail the intermediate decline we're looking for. It wouldn't be enough. So what that would mean, it would likely be this next cycle that would have that steeper decline, and that would be in alignment with the mega cap corrections, and that again would push it out into early September, which we're just following what the market's telling us. So momentum clearly strong in here. So what I want to show you in here is the value of using this multiple time frame analysis a little bit more. So I'm going to look at just these last cycles right in here, and you could see on the left the momentum indications were almost always positive. And when you get these positive momentum indications on the daily chart, when you have alignment on what we have as a 2-hour chart in here, is when you're likely to get the biggest impulses. And I'll show you more about how to use this with even some other symbols. I'm just going to look at the last two cycles right here and right over here. And you can see right here that this whole period has been positive on momentum. You can see that on the slim ribbon PO right over here. And during all of the periods where the 2-hour chart is also in positive condition, when this is green and you're getting positive signals right over here, is when you get the likelihood of the largest impulses. Again, when the multiple time frames are in line in momentum, you're likely to get the biggest impulses in that direction. In this case, those are advances. When it goes neutral, you're not really in any kind of a trading state right there. And here where it's in conflict, where this is red but this is green, you don't have any kind of a trade at all. Now, when this turns, this is still green, of course, and when this turns green again right in here is again when you get the largest impulses. Let's just bring this in again, and you can see this cycle that we're in now, which we're now in the 14th day of the rally, and this period right in here where you have positive conditions on momentum here, as you can see, and when the slim ribbon PO is green on the 2-hour chart is when you have the potential for the highest upside impulses. And you're still under that condition, as you can see right now. Until this turns red right in here, and this is also red, and this will go red first because it's a shorter time frame on the 2-hour chart, you don't really have the opportunity for any kind of a real move to the downside. So while we're looking for a correction in the market, we always give important weight to the momentum conditions, the multiple time frame analysis, and right now in the S&P 500, you can see everything is still positive. Signals coming as positive, and until these are both red, you don't have any kind of a condition where the market can move down in any kind of a significant way. So I wanted you to see how that looks back, looking 9 months back with all of those positive alignments and the impulses on the long side. Let's take a look. I'm just going to look at some other symbols in here for you to get an idea, and I've colored these a little bit more so you can really get a sense for the value. Let's look at the Dow Jones Transportation Average, and let's just look during this period here where it has been negative. You can see that right there, and I'm going to look at the same period right in here. This is a daily chart where we're looking back at this period where the slim ribbon PO, the slim ribbon was negative. And I colored this so you can see that negative period. Now here, during the periods where the slim ribbon PO and the slim ribbon were negative, that's where this is red, as you can see. I colored these. And what I want you to see is that while the dominant force over here on the daily chart was red, all this red, each time the 2-hour chart got into a red period, you were susceptible to a big downside move. And you can see each of those in here came during a period where this was negative and the dominant force from the daily was negative. Impulses to the downside because of this momentum alignment. Very important for you to understand momentum. So while the stock market has been making all-time highs, the Dow Jones Transportation Average, as we've shown before, has been in correction, very significant correction, over 13% to the downside, and these are the windows of time when the downside move has come. So there's been a correction going on in the stock market. At the same time, it's been going up. So we talk about this churning or thrashing. This is an example of that going on. There's been a kind of an internal correction or deterioration going on below the market. Let's take a look at the XLF. The financials are always important when you look at the conditions of the market. So let's just take a look at these two periods right in here. And the reason I have them highlighted the way I do is because I want you to see that during this time frame right over here, which was June into mid-July, the momentum conditions on the dominant force on the daily were negative. Here you could see the same thing. Here's that same dominant period right over there. Did I set this up as a default too? No, I did not. And each of those time frames when this was red is when you potentially had the biggest declines coming. You could see where they aligned right over here, and you had that big decline coming. But what I really wanted you to see right now is that this turned green, as you can see right there in the financials, where the upside dominant force began here about 3 days ago. And then that sets up a period where if this daily aligns with the 2-hour, you can get some big upside. And look at what happened. Just absolutely phenomenal where they both moved up together. And this signal in here aligning with this signal here gave that to you. Big upside move there in the financials. Of course, the financials do better, and they're helping the market today a lot when interest rates begin to go up, because then the bank's margins can improve. Let's just look at one more in here. We'll take a look at silver, because silver's having such a bad day. And I'm going to show you this one actually in both directions right in here. As we look at this period right in here where silver was strong right there, and we'll look at the same thing right here where silver was strong. So you have these alignments right in here where you have this back here looking in April, the slim ribbon positive momentum. It's strong during this whole period. The slim ribbon PO giving you the positive signals on the daily chart. We would expect that during each period on the 2-hour chart, when the momentum was positive, was the potential for the largest impulses to the upside. Look at how you can direct yourself here for the proper directional movements. You would never be short when the conditions are green over here, and especially you'd be long when the conditions are green over here. And you can see that 2-hour chart giving you all of these big upward impulses right there. Absolutely beautiful. It catches all of those upside moves. But now let's advance it to this period right here where silver turned negative. You can see that right there on the daily chart. and right over here. So this is the time frame where silver turned negative. This is back on June 17th, and it's been in negative momentum ever since. The slim ribbon PO red and giving you these signals. And these are the periods right in here where the 2-hour chart went negative and told you there was a high probability for continued movement on the downside. You would never be long under these conditions if you were a trader. Here is a little period right here. It gave you nothing. Here's a period right in here where it was clearly red on the 2-hour, aligned with the daily, and it brought you a large decline. And look what happened here. Let's just look during this time frame right over here, and you can see what's going on here today and yesterday, as this is of course negative. It turned red right there. And look at the big decline as you see right there. So just a very, very valuable information as you look here. This is looking at the slim ribbon and the slim ribbon PO. And slim ribbon PO, again, only available to level 4 members. This is how you align yourself for trading to get on the right side of the impulses by understanding the multiple time frame analysis and momentum conditions. As I said, the stock market has been in a positive alignment in momentum conditions for a very long period of time, despite the fact that I have been looking for a correction. I've continued to say that the market is not telling us it's there yet. And even though we can draw the lines and anticipate that on the charts with some regularity in the periods of the cycles, sometimes they do get off. And in this case, they're extending out pretty long. And we think that the stock market will have a significant correction. And if you watch in the beginning of the show, if you haven't seen that, we show you something on margin debt and the fact that margin debt is now at 2 standard deviations at the extreme on the upside. And when that begins to unravel, there's a lot of trouble. Obviously, it's not affecting the market yet, but we believe it will. And then when that begins to happen, you will see these momentum indicators begin to turn red and set up, which are some large declines. I hope you found that valuable, looking at multiple time frame analysis, and this bonus looking at the Dow Jones transports and the financials and silver. I always want to bring you the best information that I can because we won't succeed unless you're succeeding, and we work constantly to try to upgrade the type of product that we bring to you with more and more quality information. So we have a great team, and we keep working on that all of the time. Our development team is busy with the huge backlog of things that we're going to be bringing you. So that's a look at the stock market and these bonus symbols, and I hope you find that very interesting. Remember to go to askSlim.com and explore the site, and you can see lots of things that we bring on there. Become a free member, or become a new level 1 member and get that special that we announced earlier in the show, $30 for 3 months. Just can't beat that. If you're watching this on YouTube, subscribe to the channel. Make sure you click that bell. Like this video, give it a thumbs up, and watch the member videos in the playlist there. You'll get a lot of great information. Follow us on Twitter at askSlim, and for more information on our memberships, do write to Matt at askSlim.com. I want you to be so incredibly careful. As we see, it is so crazy out there. And I'm always wishing you great trading.